Good afternoon, everyone. Welcome to our panel discussion on funding your innovation. I'm Emily Dodgson, and I'll be chairing the discussion today. I'm a patent attorney and partner at Abel Imray, which is a firm of patent and trademark attorneys. We help innovative companies, both large and small, to protect and defend their ideas. In today's discussion, we'll hear from a really interesting panel who I'll introduce in a minute about some of the funding options available to innovative businesses and how these can assist you with developing your technology and growing your business. I think equity is probably one of the first options that people think of when we talk about innovative businesses, but there are other funding options available to use instead of or as well as equity, and we're going to talk briefly about some of those. We'll talk about some of the pros and cons of the different types of funding options, including equity, and also things to think about when seeking investment or in order to increase your chances of obtaining funding. So our panel today, perhaps you can give a wave as I get to you. Bryony Phillips is a scale-up lead at Rocket Makers in Bath, which is a development agency that build innovative software that will have a positive impact in the world. As a scale-up lead, Bryony is responsible for marketing at Rocket Makers, as well as engaging with local fast growth companies across all sectors. She has also run a project over the last few years to better understand the barriers to growth for scaling companies in the region. Outside of her day job, or her first day job, as I should probably say, Bryony is investment activator for the Southwest region, helping to increase the flow of capital into the region and improving transparency of the deal flow here. And then last but by no means least, on the 5th day of the week, Bryony is a nutritional therapist, helping people feel better using food and lifestyle changes. I feel very inadequate in the face of that CV. Marcus Pont is the CEO of Domin, who are a company operating in the hydraulics industry, using metal 3D printing to develop revolutionary hydraulic systems that massively increase the efficiency. Over the last 7 years or so, Domin has grown to employ around 130 employees based in the UK and Poland using various funding strategies. And I look forward to hearing a bit more about what Marcus has to say about his experience on this panel. Rosie Bennett currently heads up the investment programme at Set Squared, which is a leading university business incubator. Rosie has held senior roles and has industry experience in the media and technology sectors, working on high-profile projects and deployments both in the UK and abroad. More recently, she has been involved with a number of startups and growth companies as a founder, consultant, mentor, and incubation lead. And finally, Umar Ahmed is the co-founder and COO of XYZ Reality, a company that uses VR in the construction sector to avoid construction defects and therefore realise savings on construction projects. XYZ currently employs around 35 people. Prior to joining XYZ, Umar started his career as a business and IT consultant at Microsoft, responsible for co-managing one of their largest technology contracts with a tier 1 investment bank. He then moved on to Shell, where he was project managing a team of more than 50 stakeholders on one of their top 10 priority projects, and then moved across into the technology strategy team at Shell, directing the strategy for AR and VR. After a few years in industry, Umar co-founded XYZ Reality and has since been featured on the Forbes 30 Under 30 list. Umar has a master's in management from the London Business School and a first-class honours degree in physics from Imperial College London. So thank you to all our panellists for agreeing to take part in the discussion today. I'm really looking forward to hearing what you have to say. So I'm just going to crack on now with my first question. So apart from equity, what other funding options are available for innovative companies? I think Innovate UK is probably one of the main ones. So Rosie, could I ask you to say a little bit more about Innovate UK, kind of what it is and what type of companies it might benefit?
Yeah, sure. Hello, everybody, and thank you for inviting me here today for the panel. I think I'll just set a little bit of context first before talking specifically about Innovate UK. At Set Squared, we're partnership between six research intensive universities, so Bristol, Bath, Southampton, Exeter, Surrey and Cardiff. And as such, we work with highly innovative companies, so spin outs, but also startups from the surrounding ecosystem, so the innovation ecosystems around those universities. So for the past 17 years, we've been going and supported over 4,000 companies, and these are all innovation-led companies. So we're very experienced in helping companies with this, what we call a blended financing approach. So equity finance, but also looking at debt finance, but also grant funding. And I know we're going to talk about all that later. So just in terms of the grant funding as a non-dilutive mechanism for raising investment, it's a fantastic thing to look at. But it's very much to do with the bigger funding picture, and also about the stage that you are as a company. And I think innovative companies, by nature of the fact that we're dealing with innovation, they're very risky companies, technology risk, but also deployment risk. And as such, they're difficult things to do, they're high risk things to do. But the upside is that there's support from multiple directions, including the government, because obviously the government really wants to get these companies off the ground, because it's future jobs and growth for the UK. And so that's the context for Innovate UK. They're looking to find companies that are going to be the next big hitters in the UK, hopefully exporters of products, services, knowledge. And that's why Innovate UK is so active with supporting innovation at a very early technology readiness level. So, 1 to 5, you can get some really good grants at 70% match to an equity finance. And then later stages, you get further to market. It's normally around a 50-50 match in terms of grant to equity. So I know we can probably talk about it a bit further, and I know that Marcus and Uma have had experience of Innovate grants, but the key thing to look for is at the moment the grand challenges, because in the wake of COVID, there's a lot of the Innovate money and the government money is being diverted to support struggling companies. But you can still look in terms of sector and the grand challenges which the UKRI puts out. So AI, ageing society, clean growth and future mobility. These are currently the kind of grand challenge sectors. But of course, those sectors have a massive scope, and you can see calls coming out under each of those themes.
And so you can interpret those themes quite widely, can you? So if you can see yourself somewhere in there, it's one to look at.
Yeah, so obviously there's enabling technologies, things like AI, which cut across sectors. But there's also things like green growth, which go into automotive. It may go into battery storage. It may go into tools for SMEs to be better productivity. So it's very broad in terms of the themes that come out. But the real key with any grant funding is to make sure that you're applying for the money for the right reasons, and that it's aligning with your growth path as a business, because it's very easy to get distracted and see it as free money and to go after it. But actually, it needs to be part of a bigger plan, a bigger funding plan, and a bigger growth plan. And
so if you are looking at, say, Innovate, and you think you fit into one of those calls, would you have any particular advice in terms of kind of practical steps to helping to get or increase your chances of success?
So collaboration is a really key thing that will increase your success. And obviously, as a university incubator, that's what we do. We introduce companies into the universities to be part of a big application, and that's where you can get the real innovation, and that's where actually you can prove the market traction as well, and the fact that you've got a market, and those are the things that are going to be really a differentiator for your application. And it's all about de-risking the project and putting it as part of your business goals, and not seeing it as a project that's purely about research and about R&D. It's got to be about the market. It's got to have market application.
Umar, Marcus, I think both of you might have used Innovate. Is that right? And how, why, what advice would you have about it?
Marcus, do you want to go, or should I go first?
You go first, Umar.
So we've used Innovate UK quite a lot. I think the Innovate UK scheme is great. We've won a couple of grants. We've centered the Innovate UK grants around our business. So as Rosie said, choose a theme. So there was a particular theme on reducing the carbon footprint in construction, for example. So that one was right up our street. So we went for that one. If I kind of just touch on different key areas. So you've got the kind of, what grant do you want to apply for and how much? So you can either apply to do the whole thing by yourself, and there's a limit, there's a threshold for each grant on that one, or you can apply for a slightly bigger grant. The bigger grants can go in order of millions, and if you have a collaboration, if you have different people in the supply chain, partnerships with other R&D, partnerships with customers that want to trial it, you can really get that big collaborative grant. But alternatively, if you just want to focus on R&D by yourself and keep all the IP in-house and you don't want to do anything with anyone else, there's also the single grant. So there's two options you go for. So you can choose whichever one suits your business. Then comes the application step. So the application for Innovate UK is very interesting, because if you don't get it the first time, so we applied for our first one back in 2017, we didn't get it. They basically give you the feedback. It's great. It's different to other grants where they say, sorry, you're rejected. You didn't meet the threshold. Thank you. Innovate UK actually tell you exactly why you didn't get it. So it's very easy to just look at the feedback and say, okay, I didn't talk about this, this, and this. And then the next time you do it, you can significantly increase your chances of applying. And then the stage after the application is obviously receiving the grant funding. The grant funding is very important because, as Rosie mentioned, you need to have like a goal and objective. It needs to fit into what your business is doing. So for us, we were developing the AR headset. We needed Innovate UK funding because there's not a huge appetite for hardware investment in Europe. It's a bit of a chicken and an egg. Typical financial VC would say, well, where are the sales? But to make the sales, you need to build a product. To build a product, you need money. So how do you counteract that, that vicious cycle? Well, you need some sort of third-party funding, and Innovate UK is great for that. And it's been really instrumental in driving our company forward.
So it sounds like you had a pretty positive experience with it
definitely.
overall. Would that match with you, Marcus? Was that your experience as well?
Yeah, I think I'd agree with almost everything that Umar said there, and further agree with Rosie's position that the most important thing is that you are applying for funding that matches your business objectives as they are, and that is the right way around to do it. And first of all, you find where your company wants to focus, what you want to invest in, the technology you're looking to achieve, and then you go and look to find the funding opportunities within Innovate UK. And the specific themes are great because there's a high chance of success within them. But one of the funding streams that we've been most successful with Innovate UK is the Open programme. And that is effectively funding that you can apply for that is completely independent of technology theme, and it can be anything. And that's more competitive because, for obvious reasons, there are more people that can apply for it and the scope is a lot wider. But it does mean that there is always an opportunity for you to apply for Innovate funding, no matter what it is. And so that puts more importance on making sure it is aligned to your business objectives. But yes, in direct answer to your question, Emily, we have been really successful with Innovate and have found it largely very positive. We applied for our first grant in 2013 and did it collaboratively, and that was really successful because we were looking to try something completely new that we hadn't done before, and the collaboration allowed us to learn a lot really quickly. And then interestingly, we went for a number of years applying for projects where we just focused on ourselves because we were developing that core business IP. And as Umar said, we wanted to maintain ownership of that IP. We wanted to make sure that we weren't sharing it at that point in time. And that was also really positive. And now we've gone full cycle, and the grants that we're applying for now are much more collaborative, but in the sense that in the beginning they were collaborative with other research institutions or subcontractors, whereas now the collaboration has taken a focus towards end users and customers alongside research institutions. So that's the shift in the process that we've gone through, and all three of those consortiums have worked really effectively for us. And I would also second Umar's view that generally Innovate UK operate pretty well. We've had positive experience with them.
That's good to hear. So we've got some time for questions at the end, so we can always come back to Innovate UK if there's more to say later on. So apart from Innovate or equity funding, Bryony, what other types of funding is out there, and what types of companies might benefit from them in particular?
Good question. So as you mentioned in the introduction, and it's great to be here, and thank you for the very kind introduction. My work over the last few years has been really looking at what the barriers are to growing companies in the region, and to expanding on that and understanding actually what can we do about it by trying to encourage the public and the private sector to make changes. And in that work, I've obviously uncovered lots of information about funding and finance, as you would imagine, because it is the second most important barrier to growth that companies experience. And the thing I found most useful was a kind of upside down triangle, if you will, in terms of the options that are available to people. So imagine you've got your pointy bit at the bottom and you've got equity at the bottom of the triangle. It really is something that's pretty hard to come by and requires quite a lot of hard work in order to secure it. At the top of the triangle, in much larger size, is the thing we've just been talking about. So that would be our grant funding. And as Marcus said, the open calls are fantastic, but they are highly competitive in comparison with those that are focused on the grand challenges. But that's kind of option one. And if that doesn't work for you, then I'd probably be looking at bootstrapping, if that's at all possible. So think about how you can actually fund your business. If you are ultimately going to ask somebody to invest in your company and you're going to sell them a part of your company, you need to demonstrate that you've put some skin in the game first. And that skin in the game might be through sweat equity, it might be through working hard and not taking any money out of the business, or perhaps it's going to be through actually finding some funding from friends and family. So you might have a wealthy relative or somebody in your network who supports the project that you're working on, or who conceived of it with you and wants to be part of the journey and is willing to put some money in to support you. And that really does rely on your social capital. So that kind of bootstrapping options are dependent on who you are and where you've come from and what you're trying to achieve and how much money you need to do it. And then if that's bootstrapping options aren't the way to go, then next up I'd be considering debt or loan funding. Somebody asked a question I see in the Q&A already about asset-based funding, asset-based finance. And so certainly if you have got assets that you can leverage, some people take out a second mortgage, other people are looking at the assets within their business, of course, in terms of hardware they might have already secured through some funding, grant funding perhaps. So debt or loans, and then ultimately if that doesn't work out for you, then I'd start looking at equity. So there's lots of different options available. The best tool I found to help you navigate them is on the British Business Bank. They have something called the Finance Hub that's worth Googling, and you essentially just put in how much money you're looking to raise, and it will give you the different options in terms of ways in which you might be able to secure that funding. One of which, of course, I haven't mentioned, but does appeal to many people, would be crowdfunding. So I'd probably add that into that kind of, it depends on the different types of crowdfunding that you go for. So it's a bit more nuanced. So if you're actually looking for to raise funds for a consumer-focused business, a B2C business, then of course those platforms are available. There are also equity funding platforms like Crowdcube and Seeders, where you'll find angel investors who are making investments through platforms in order to perhaps grow their portfolio and make a larger number of smaller investments, but that's not always the case. But crowdfunding has its own nuances too.
And presumably people will move up and down the pyramid. Different things are going to be the right option at different points in the life cycle. Is that fair to say?
Yeah, absolutely. And it really does depend on what your business is and the traction that you're able to build and how quickly you're able to do that. And ultimately, you know, an equity investor is going to be looking for you to have de-risked the investment a little bit along the way, and that's usually through demonstrating a product market fit, and then building that traction within the market, demonstrating your first sales, etc. And as you move along that journey, different funding options are going to become available to you depending on your current circumstances.
So we'll start with Marcus this time as we go to the business owners. Marcus, what of these other types did you use, and when, and how did that kind of fit together for you?
Yeah, it's a good question, and it's a few days of storytelling, I think, to go through all of them. But for the purposes of today, I think that triangle is a really interesting thing to think about. And actually, if I reflect on the previous 7 years, I think that if the triangle is about how sort of difficult and challenging it is as you go down, I think we've seen that change over time, and in both directions, actually. So for us in the very beginning, we very much committed our own resources to the business, both cash, but also sweat equity as well, for a long time. And I think had we not done that, then the investment that we've taken on and the progress that we've made would not have been achieved. And I think that that's something that shouldn't ever be underestimated when you're looking to start out by yourself, is that you are expected by almost all stakeholders to have committed your own time and effort and finance yourself to the business. We have found that for product development, hardware development, raising debt has actually been the most difficult thing. And equity investment requires you to have de-risked the technology and the market for us. And in our experience, debt has required us to make the risk zero. And that is either with assets or with personal guarantees and things like that, such that whilst on the face of it, it might seem that the risk hasn't been taken out, but actually for the debt on the bank or the funding person, the risk is zero. And so that's been a really interesting experience for us. So debt has been our last resort over the years, but we have used debt, and we've leveraged it through things like personal guarantees and mortgaging. And as we've grown ever more, we now have a production company, and then suddenly debt is very easy because we have assets that we can just charge the debt to, and then, as I say, it's zero risk for the bank, but we have cash in the business.
Yeah, and it's been an interesting journey, because I've worked with you for the last 7 years or so, and it's been very interesting to see kind of how your plans and strategies of things have changed as you've tried to grow the business.
Yeah, I think that's right. And I think that whilst you do have to have a really clear strategic objective about what you want to do and align your funding to that, as anyone who has started a business will tell you, one of the most important assets for the person running the business is having that bigger picture overall objective is super important, but being able to respond to change and adapt to new information is actually more important. And so that's why we have, as that triangle has shifted, we have to take a different approach to the funding that we raise as we go along the journey.
Umar, how have these other funding sources played into your journey?
Yeah, I think the funding journey has been very interesting. As I mentioned before, there was that vicious cycle, right? That if you're a hardware company, you need to have some sort of, VCs will demand certain traction, certain sales, and it's kind of part of their criteria and the checklist that they need to have before they invest. So a hardware company, you're kind of forced to be innovative. You're forced to look for alternative solutions. So what we did was we broke that cycle in two ways. Firstly, Innovate UK, that was a massive help. But secondly, strategic investment, because when you're developing a hardware product, there's certain strategic companies in that space that don't necessarily need to be convinced of the value, because they know the value, they see the problems, they suffer from the problems every day. And it's a lot easier to have that discussion with them, and then they can kind of help provide that angel investment for and then supplement that with Innovate UK, and then you can build your prototype, get the sales, get the traction that you need to start ticking off all of that criteria on your standard VC checklist.
Okay, so moving on to the VC checklist, then the equity, the tech unicorn startup dream. Umar, what role has equity and different types of equity played in your journey? Once you did you manage to tick off that checklist, and kind of where have you got to?
We did indeed, yeah. So we started the journey with Innovate UK, an equity angel-based investment, used that to build the first prototype, demonstrated some traction out in the market. And then in 2020, so last year, we were funded by Hoxton and Amadeus, which are two of the leading VCs in Europe. So we've kind of gone along that journey now, and now we're looking to take to the next stage where we expand globally. So we get a kind of more of a global cap table, bring some leading tier one US VCs in. So we're pretty much down that kind of VC route, but there are alternative options. All depends on your business. B2C businesses can have a lot more flexibility in terms of crowdfunding. You can use seeders. I'm not an expert in any of that because we're pure B2B hardware, but it all depends on the nature of your business, that there are a lot of other options out there for you.
And was equity always your end game, or that kind of the kind of growth and global growth that comes with equity? Was that always what you were aiming for, or did that change?
Essentially, yes. We've always wanted tier one VCs on our cap table because we know that they have the resources and the capital and the ability to scale unicorn startups to billion-pound companies. So they have the experience. They've done it before. Like Hoxton have invested in multiple unicorns. So they've been there. They've been on the board of Deliveroo. They've taken them from seed to where they are now. So it's just having that experience has been great.
Marcus, what was your equity journey?
Yeah, equity's been a really interesting thing for us as well. I think one of the themes coming out here is not only is everyone's journey for funding their business interesting, it's also very different as well. So we have experienced both strategic angel investment, very similar to what Umar was saying. So our first investor was somebody who worked in the industry, so they were currently in the supply chain, and they could see the value proposition of what we had brought at a very early stage, and it meant that we didn't have to have that traction in the market because the market was understood and known, and that made the investment really easy, almost uncomfortably so, looking back on things. Since then, we then made some strategic decisions to try and develop a little bit of revenue at the same time, such that we weren't coming up towards a cliff. And that's something that has then framed the next round of equity we were looking to seek. And actually, we were getting quite close to a cliff in terms of our cash projections and where we were in the business. And we were seeking to raise equity from VCs. And we engaged with a strategic VC partner in Germany. They were a good fit. And we got a long way along the journey with them. We had agreed terms, we had investment documents drawn up, due diligence had been done, and it was pretty much the day before we were signing the investment, they suddenly added another clause into the investment contract, and it really fundamentally changed the sort of what the investment meant for us as a business in terms of control over ourselves personally as founders, but also as in terms of control of the business. And so we had to take the really difficult decision to turn that down. And that was a really interesting learning curve because it very much seemed that they had played at that game strategically to take us to the point where we had already psychologically and emotionally invested in this round and then changed the terms right at the end. So that was really interesting. From there, we did then go on to take investment, but we didn't end up with a VC. We ended up with taking investment from some high net worth individuals. And we've found that to be, again, really useful for similar reasons to talking about that that investment in strategic sense. So having a shared vision for what we want for the business with the investors changed things for us, because the experience with the VCs was very much they were in this they wanted to exit in 3 years, whatever it was. They wanted to make money for their fund, and that was fine. We knew we were buying into that. But what's been interesting with the high net worths over the last 18 months to 2 years is that they've taken a much more strategic interest in the business, and in similar ways that Umar has talked about, they've been through their own journeys of growth, involvement in various different businesses. And much like the VCs, I'm sure, they also open up connections to other people within their network. And like we were talking about in the beginning, your social capital is so important when you're growing a business. And so then being able to be connected to other people in that network of transitioning from high net worth to super high net worth individuals who share a vision for changing things has been really beneficial for us.
So it sort of sounds like it's not really just about getting the funding, it's about getting the funding with the right partner, both, you know, whether that's the right VC fund like Hoxton, or whether the right individuals who buy your vision.
I think that's really important. Yes, I think if you're thinking about taking on equity, I think one of the most important things to do is to forget about the number that's being put at the valuation of the company, because it's never actually the real number, however you frame it. Either they're using EIS investment, as I think we'll talk about in the future, which is a way for them to reduce the tax on their investment, which means that they're actually not investing at that number. Or there are things like convertible debt, which means that they're holding back in terms of the leverage that they're putting on the cash, and forget that final number and focus more on the bigger objectives that you share with whoever it is you're taking equity investment from, because they will form a significant part of your stakeholder and your cap table as you grow.
Rosie, Bryony, I mean, how do you see equity? Is this
I think that's
you
a really,
people first, or?
Yeah, no, really good advice there from Marcus, because I think you know, when you're talking about the pros and cons of equity, the cons are definitely to do with control and to do with the investors taking your company in a direction that may be good for short-term sales and hitting targets, but might not be good for the long-term innovation aspect of the company, which is more nuanced. It might need a slower approach. And I think you're right in saying that high net worths who've been in that situation are much more sensitive to those types of growth paths. I think with equity investment, though, if you are going to go down that route, it's really important to think about it from the end coming forwards, because obviously equity investment relies on an exit. So your investors want you to exit in order for them to realise their investments. And so that naturally gives a certain growth path to the company. But it also means that you're likely to go through a number of rounds of investment in order to hit that final exit. So whatever your first investment is in terms of an equity, as in terms of a term sheet, that is going to set terms for the whole journey. Obviously, as you go along, you'll have new term sheets and new investors come on board. But it's really important when you start that journey to actually have some idea about how you're going to get out of it, because that's going to really influence the type of funding you take on, the amount of funding, and the timing of that funding. And I think going back to the whole blended investment path, that's why it's really good to weigh up all these options so that you can minimise the amount of money you have to bring in through equity.
Bryony, did you have?
I'd echo all of that. My cons were a little more fundamental. The first one I was going to mention is the language, and it is like a language of its own, I think, learning about investment and the way that the process works. And just as Rosie has articulated, the importance of starting with the end in mind literally can't be emphasised enough. There aren't enough patient capital, or isn't enough patient investors in the UK. We are very different to the States and to Europe in terms of the amount of capital that's flowing about when it comes to equity investment, and consequently that means people are looking for lower risk and quicker returns, because they want to redeploy their capital into the next exciting project, hopefully, fingers crossed. And that really does leave us in a tricky spot as far as making sure that you find the investors who match your ethics and values for the business and your objectives for the company. So I'd say, first things first, if you're totally confused by the language, take a look at Y Combinator's Startup School, and just spend a bit of time reading through that. It is an online course which is free if you want to do the whole thing, but there's also some great resources on there just to help you get your head around, well, what do we mean by a cap table, and what are the implications of taking X% or selling X percentage of my business, to really get under the skin of that. What else was I going to mention? Yeah, I guess the other thing that Marcus has emphasised, and Umar as well, is the amount of support you can get through equity investment that you wouldn't get if you took a loan or you work with friends and family necessarily. And so there really is a huge amount of support available if you're able to tap into it. And that's key, really. So I talk to founders who tell me they have to spend 70% of their time courting, engaging, finding investors, and then getting to the point where, as Marcus says, you finally get to the bit where they're like, here's a term sheet, let's make this happen. And even then the consequences can change dramatically and overnight. So really thinking that through in terms of the whole process is key, and recognizing that when you get them on board, they probably are going to support you, and even if they don't invest, they might introduce you to the next person who is going to invest. So literally every meeting matters, every conversation you have, and the more people you can get to know in your industry or in the investment scene who might work on your side, the better, really.
So as part of the jargon, and sorry, Rosie, did you have something to add there?
I was just going to say that, just to follow on from that, with the institutional funders, and exactly like Marcus said, when you find the right, if you are a potential unicorn, which obviously Marcus and Umar both are, that institutional funding is going to really, really help with your global expansion. So there's definitely the time and the place for the right type of VC.
Yeah, so it's not the case that equity is bad. It's
No.
clearly not, but it's about timing it to the right place and taking the right kind of equity.
Yes.
Yeah. And recognise, of course, that when you take that institutional investment, the worst thing that can possibly happen potentially is that those investors will decide that you're not the best person to take that business forward. And that can happen, and can happen in a really dramatic and uncomfortable way. So, those are the ultimate consequences of taking equity investment if things don't go in the direction that the investors want to see it move in. But as you say, hugely valuable. Rosie, couldn't agree more in terms of global expansion and making that network work, and really building the impact of your business so you do get the exit it deserves, because that is one of the biggest frustrations with the UK scene, tech venture scene, is actually that many companies exit sooner than perhaps they should do. So yeah, it's key.
So we talked about it briefly, and this is part of the jargon of the scene, the enterprise investment scheme and the seed enterprise investment scheme. I mean, we're running a little bit behind time, so if we can keep it brief, but broadly speaking, and I know you're not an accountant, Rosie, but what are they, and where do they fit in with this picture?
Yeah, so these are tax breaks really for interested investment, and they're really, really valuable in the UK for driving angel investment in particular. And I think you can't do better than an angel at an early stage in your growth path, the right type of angel. So the EIS scheme means that for companies which are new, and also the rules are changing, so you have to be R&D intensive in order to qualify for SEIS. So the one that's most beneficial in terms of tax incentive to an investor. But it basically means an investor can invest in your company and then get a percentage of that investment back on their tax return. And it just drives early stage investment. There's a limit as a company to how much you can take, and it's up to £2 million for companies in terms of SEIS, and then EIS, which is the later form of the scheme. But then there's VCT Trust as well. So there's later stage again, which got to £10 million. So it's really important for driving investment into UK companies.
And are most kind of UK innovative startup companies going to fit the criteria for those two schemes?
If you're innovative, yes, that is the key word, yes.
Okay. So I think we've talked about some of this, but you might make sure you're eligible for the Enterprise Investment Scheme. What other things did you, Umar and Marcus, or in your experience, Rosie and Bryony, do companies who are successful at the equity route have sorted in advance? You know, what do you need to be thinking about if you think somewhere in your future equities?
Obviously, as an accelerator network, I would say try and seek support where you can. So, you know, there's lots of free advice available, as well as, you know, you can obviously paid advice, but you know, there's as I was saying before, there's so much support available, because the types of companies you are, when you're doing innovation, you're valuable to this country, you're valuable to the universities, you're valuable to your local enterprise partnerships. So there is support. So, you know, I would seek that out, and also in terms of early stage investors, you know, the amount of knowledge and goodwill and advice that is on offer if you ask for it is phenomenal.
Marcus, did you have anything particular that you'd?
Yeah, I think if I could pick a theme for me, I think one of the most important things, and it might sound a little bit bland, is professionalism. And I think that can encapsulate quite a few things within the journey, because understanding the jargon makes you appear professional and knowledgeable. People often talk about making sure you have your business plans all prepared and things like that. But actually, there are very different ways you can prepare business plans and look at financial models and things, and having them done in a way that screams professional is actually often one of the things that we've heard most when people talk about investing in new companies, is this sort of risk around it. And it's interesting to hear your comments, Bryony, on removing founders from the business. And if your ambition is to grow the company and lead it, then actually you have to show that it's not just this innovation that's important, but the management team as well. And often professionalism isn't necessarily married with this sort of idea of a super innovative world. And so I think that preparation and professionalism is really important, and the ability to learn is just incredible. So some of those tools that we've talked about, but also just generally the internet is incredible for you to become a pseudo expert in financial modeling is actually really easy. For you to be able to become say expert in understanding all the terms that people use in investment and understanding the different types, you become an expert in tax, so that when you speak to people who are prepared to invest in the business, you can say to them, well, this is great, but have you thought about this and this? I think is really important. You sort of becoming a master of everything, I think is an important thing as you're seeking early stage investment.
So we've had an interesting question come in that kind of fits well with this part of the discussion, and that's about protecting your IP, which is something that interests me, obviously. But you know, how did that fit in, or how does that fit in for the companies you see, and how do you balance the fact that you've got to spend some money if you're thinking about patents, that you're potentially disclosing what you're doing if you're thinking about patents, and how do investors view that kind of IP as well? Umar, did you have anything to say on that topic?
Yeah, sure. So IP is really important. I think if I was to choose three main ingredients, just following on from the last question, I'd say the management team is very important. Customer traction. Can you show the beginning of a sales machine? Can you show that if you hired people, they can replicate what you're doing and continue? And do you have some sort of sustainable advantage? And in a product-based company, your sustainable advantage in many occasions can be your IP. So that is very important. It's not the be all and end all, because if you had your IP but you don't have customers, you don't have traction, you don't have a good management team, nobody will go anywhere near you. So you need to make sure that you have the three. I would say those are three very, very key ingredients. IP, very important. So investors are, you know, a reasonable investor, an experienced investor, should I say. No experienced investor is going to ask you to disclose to them any unfiled IP. And if they do that, and if they're pressuring you, they're not a very experienced investor. So there should be some red flags there. You know, the most they would say is, okay, can you just give me an indication as to what, you know, what area is the IP in and what will it facilitate? If they start going into the details and saying, tell me how it works, that's a red flag, because that shouldn't be happening. None of our investors did that. No experienced person would do that. It's very reasonable for them to say, okay, show me the IP you've already filed, because I want to check that. That's reasonable because you've already filed it. So, and they're investing in you and they're doing the due diligence. So they should only really do that when they're at the due diligence stage. So yeah, hopefully that kind of gives a bit of insight into IP, why it's important. And there's some other really important things in IP as well. So experienced investors will also ask, how does this IP benefit the company? Because you don't want to do is you don't want to file IP for the sake of it. You don't want to just come up with an idea, and you know, if nobody else cares about that idea and it's not a very useful idea and it's not going to add value to the company, then you know, you're just wasting money. So you need to really think about, is that IP a, for me it's one or two things, and Emily can probably advise from the other side of the table perspective. From an entrepreneur's perspective, it's really two things. Number one, is this going to stop other people from doing what I'm doing? And if it's not, then there's another situation in which it's worthwhile filing IP, is, are a lot of people going to want to use this? And when I say a lot of people, I mean, you know, big companies with a lot of money. Can you foresee that those guys would see something valuable, even though it overlaps? Does it overlap with what they're doing? And if it does, that could be very valuable too, although that will be slightly longer term rather than shorter term.
Yeah, I think the difficulty is sometimes in knowing which of these are the winners to back, and as a startup business, you don't want to be spending too much on your IP, because in the early days it can be quite a significant amount of cash, and then once you start filing patents, you've started the clock ticking. You've kind of set up some costs that's going to come down the track at you. It is a very difficult decision as to when you sort of start to incur that cost, and how much of it you incur. The flip side of the IP thing as well is whether you're going to be able to do what you want to do, and some investors might want some confidence that you have freedom to operate, that you're not infringing anybody else's patents to do what you're doing. Marcus, how did I don't want to talk too much about IP because I think there's lots of other things to talk about. But yeah, I mean, other issues for success in equity, or ways in which IP fitted in.
Again, I think IP is obviously a really interesting thing, and it's specific to each business. And I think I'd agree with Umar that it's important that your IP is actually going to stop other people from doing things. One of the interesting things, I think, is that innovation largely isn't just one big breakthrough idea. It's almost always innovation through a million little ideas. And actually that makes often patenting things really difficult. And we were fortunate that we actually entered the sector that we're in relatively early days, and we have been able to file a few patents that are really broad and do genuinely, well, we believe, protect us. And the final thing I'd add on top of Umar's thing is, not only does it have to stop someone from doing what you're doing, but you also have to be prepared to take them to court. And if you are not prepared to do that, either as an individual or as a business, then you think very carefully about whether you're prepared to spend the money, because it could well be very much wasted, and something that we're coming to terms with at the moment, and it'll be interesting to see how that pans out. For investment, we found two extremes in some ways. When we were seeking some VC funding, I spoke to a few people at some big investment banks, and their view was almost like a CV. They would only entertain a company if they had filed a certain set number of patents, and so there was a threshold with which they wouldn't engage unless you had X, which we found very strange as a business. And then the other extreme has been people who have sort of committed to saying, well, look, IP is sort of just a number on a screen and doesn't really mean anything. So we've seen different extremes with it, and we've ended up, I think we've ended up with a bit of a balance in between. But certainly I would echo Umar's view that patents definitely have a place, but they don't have to be the thing that you do by default for everything.
Rosie, Bryony, was there anything more you wanted to say about kind of real key points for people looking for equity that they need to think about or get sorted out in advance?
I think timelines are really important. So if you're thinking about going for equity, then you need to be doing that. You need to be thinking about it a year in advance. You need to have 6 months at least prep time, especially if you're going for a later round like a Series A or later. You need to have everything lined up before you go and meet investors, including a complete understanding of the investor landscape for the type of sector you're in and the amount of money you're asking for. I think that at a very minimum, that's going to increase your chances and stop wasting time. As a founder or as a key member of the company, you don't have time to be chasing around hundreds of investors. So as much as you can do to focus your target is good.
Yep, I'd echo all of that.
Cool. So I'm conscious that we're running out of time. So, what are next steps if people out there are thinking about how they're going to fund their businesses? Where can they go for advice? What resources are available? Bryony, do you want to kick us off on that one?
Sure. So I've mentioned a couple of things already. If you're looking at alternative funding, then I'd start with a website called alternativebusinessfunding.co.uk, which is just a listing, like compare the market really for all of the different loan and debt services that are available out there, worth looking at. I mentioned also the British Business Bank's Finance Hub, which is great to give you a kind of overview of the different options that are available. I wrote a blog this morning, which is on the Rocket Makers blog, about angel investment, which you're very welcome to look at. I think John's going to share the link in the follow-up after the event. And then I also run something called the Investment Activator Programme with TechSpark, which is a 2-year pilot to help companies access funding and finance, and also to try and, as you mentioned at the beginning, improve the investor landscape for the west of England and the wider southwest region. In terms of things that people can access through that, there's 3 particular services. So one is an event called Pitch Me, which is an informal lunchtime event where early stage businesses can practice their pitch, or if you've significantly changed your pitch and actually you just want to practice something new, and get some informal friendly feedback from some of those fantastic supportive people in the region, then that's open to people and you're very welcome to get involved. The second thing is Silicon Gorge, which is a formal investment pitch competition, which we're running again in March. That's if you're ready to raise funds and you want to put your pitch in front of a room full of investors. We usually get about 70 applications, and 12 of those will go through to a final round, which is a room full of investors virtually. No surprises there. And then I run an event called the Quarterly Investment Briefing, which is also happening in March. And at those events, founders are welcome to put forward a 1-page executive summary of their proposition, and we then circulate that to a community of investors who've expressed interest. So there's about 300 now on the list. We can't guarantee that any of them are going to look at your individual exec summary, but what we're hoping is by kind of putting all of that information out there, we might increase the flow of interest in the region and the flow of capital ultimately as well. So yeah, those would be my top tips.
Excellent, thank you. And I think John's going to send around some post-event information with some links to some of those in as well. Rosie, is there any other resources or?
Well, obviously, we love to hear from companies. If you're a growth company you're innovating, if you want to join one of our accelerators, if you're in one of the regions that we represent as universities, but also we have a scale-up program. So if you're looking to do joint collaborative grant application with a university, we can fund that, so we can help you do that. So yeah, really keen to talk to companies which are looking at continuous innovation as a growth path. In terms of applying for grants, so there's a really good agency called granted.co.uk who do some fantastic resources. They do a really good blog. They highlight calls that are coming out from the government. So that's a really good one to look at. Also sign up for the KTN, so the Knowledge Transfer Network, which is the kind of government agency that can connect you to other SMEs and other research organisations which are looking to collaborate.
Great. So very quickly then, as we come towards the end of the discussion, just going to go around you one by one to ask for, one thing you'd particularly like people to take away, or one thing that you maybe haven't had the chance to say yet that you wanted to say. Umar, can I start with you?
Well, it's hard going first now. I think one thing that is very important is having a cohesive story in your pitch deck. So the three things that I mentioned before: do you have a good team? People are going to look at that. Do you have a good product, and is there customer traction? There's no customer. I mean, if you're a hardware product, you need to be very, very creative about how you showcase that customer traction. There's ways to do it. It's much harder. Obviously, if it was a software product, you could just get a prototype and get people using it. But there's creative ways where you can build hardware prototypes, hardware mock-ups, but you need to show some sort of traction. And then on the IP side, you need to also demonstrate why your IP is valuable, and how you are going to get a sustainable advantage in your company. So anybody who's looking for investment and is creating a deck, make sure you cover those three things.
Great. Rosie, did you have a final point for us?
Just knowledge is power, preparation is key. That's it, really.
Nice and brief. Marcus.
Yeah, I think for me, and I think this is true for any funding that you take on, whether it's grant funding, debt, whether you personally invest time and cash into the business or you take equity, is make sure you've got a really clear strategic vision of what you want for yourself and the business, and both those things, not just one or the other. And that at any point in time that you take on funding from other people, be aware that that's bringing in another stakeholder, and make sure that both that stakeholder and the investment is aligned to your objectives for yourself and for the business. And if it's not, and even if it was for a long time but becomes not, don't be afraid to turn it down, because there's the only thing worse than not succeeding at where you want to get to is being forced to do something that you don't want to do. So that would be my takeaway.
And Bryony, over to you.
Very wise, Marcus. Speaking from experience. I was it was actually echoing Rosie's point and picking up on something she said earlier, which is timelines, and being clear that actually it's not an overnight solution to find the funding you need. So start building your network now. There's a huge amount of people who will help you along your journey, whether it's online resources and becoming an expert through your research, or whether it is through talking to people and starting to build networks with potential investors. There's no time like the present.
Right, well, thank you everyone for taking part. It's been really interesting. We've got a few minutes left, and we've had some questions that have come in. So hopefully you've all got the time for us to talk about a few of these. I think some of them we've already covered in the talk today. We touched on it briefly, that there are differences between the US and the UK and other places. Is it quite different, and why and how can you exploit that as a UK business? Can you reach out to investors in other places to try and overcome some of those issues?
You can, absolutely. We live in a global world, no more than at the moment, really, now that we're all working behind our screens anyway. So yes, it's hugely different, largely in that the States have, I believe the last calculation was 3 times more equity funding floating about relative to the number of investment opportunities. So there's just a huge, significant amount more capital available, and a considerable difference in their appetite for risk, frankly. So American investors will, on the whole, look at a pre-revenue business much more readily and invest a lot more in it than perhaps our British equivalents would, unfortunately. So that's a real challenge. I think Marcus made a good point actually earlier before the conversation began, which is about the implications of taking on international investors if you are using SEIS or EIS tax reliefs. So I won't steal your thunder, Marcus, but I'll just cue you up perhaps to talk about that briefly.
Yeah, I guess for us, and if you are looking to use EIS and SEIS, which I would highly recommend because it does give considerable de-risking of investment into inherently high-risk companies. do be careful whether it is only applicable for people who are tax resident in the UK. And further to that, also don't suffer from any potential double taxation treaties that exist, such as if you have dual citizenship with America, where that EIS relief will not be recognised. So there's certainly some challenges there. I think it's a great question about the US and UK, and I think it's often talked about without, I don't think, a really strong answer. But I think one of the things that we haven't touched on, but in detail, but it's been mentioned quite a lot by both Umar and myself, is the difference in investing in hardware and software companies. And actually the difference between America and England could be just as big as the difference between starting a software company and a hardware company. And the challenges in investing in hardware should not be underestimated. They often require more work done ahead of investment and more personal time and energy and investment in those things.
Umar's nodding there. Is that how you'd see it as well, Umar?
Yeah, exactly. Yeah, spot on. Just echo what Marcus said there. A lot more work required.
So another question we've had come in from Tim at Phoenix Ventures. My business assists enterprises in releasing value from soft and hard IP. Intangible asset finance and lending in particular was a growth sector 5 years ago. Can you share your experience of this, and what is the state of play now? Is that something that anyone's got experience of, and how it might have changed?
No, I know it's still a thing, but that's the extent of my knowledge.
No, we haven't taken on debt for intangible assets.
No, I know we often get asked about valuing patents, and for that kind of reason, and it's something that is very difficult to do. And as far as I'm aware, it's not my area of expertise, but there's no hard and fast way of doing it, or no one way that people have found that is successful or accurate in a clear way.
I think a few companies in the Set Square portfolio have taken funding through IP Group. Is that right, Rosie? Is that?
Yeah, but I think that's it's an equity funder, isn't it? So I would say that was more of a mainstream venture play.
Yeah. Okay.
I just want to, I know it's not America, but it's worth just mentioning about Europe, because they've just announced a £10 billion innovation fund, and it's a follow-on from the Horizon Fund, and we are still allowed to be in it despite Brexit, so that's really good news. So it's definitely worth, you do need to find collaborators in Europe, but you know, the KTN and other organisations can help with that, so really good one to look at.
Yeah, and I guess Set Squared and university type organisations are often doing international collaboration, so that's another way to try and find those partners. And
fantastic way to find markets as well. You know, as Bryony says, we live in a global marketplace now, and actually finding those collaborative R&D grants is a really good way to access those markets.
Great. Well, we're 3 minutes past the hour, and I think we've touched on most of the questions that we've had in. So I think we'll call it a day there. Thank you once again, everyone, for taking part, either as a panelist or if you've listened in. I hope it was useful. And yeah, I'll leave it there. Goodbye. That's goodbye from me.
Thank you. Bye.
Cheers. Goodbye.